$1 million. Man, we've all sat and imagined what we do with that type of money. Dream vacation, new car, new lifestyle. But for many of us, it just seems so far out of reach. It's like you either have to be born with the certain advantages or just be lucky. Hit the jackpot in Vegas or scratch the winning lotto ticket. But what if I told you $1 million is much more time than you think? No slot machines, no lottery tickets, no silver spoon necessary. Would you want to know how? Of course you would. We have the answers you need and so much more. Our mission is to help you build wealth one video at a time. Welcome to the vault. What's going on, family? It's your favorite headless YouTuber back at it again with a brand new video. Today's video is our third and final episode for our stocks and options series. Before we get into it, let's kick it off with some Monday motivation. Every day is a fresh start, and time is our currency. No one is rich, no one is poor. We've all got 24 hours each, so it's best we make the most of it. In today's video, we will conclude our discussion on options and talk about in the money versus out of the money. And we'll bring it all together with an example using Robinhood's platform. And of course, as promised, I will be telling you exactly how anyone can become a millionaire in as short as a year with a very simple concept. If you want us to make more videos more often, please subscribe to the channel and turn on notifications so that you always know when we post new content. Without further ado, let's get it. If you're just joining us on our stock and options breakdown series, be sure that you're caught up by watching the first two parts to our discussion. I promise you'll be thanking me later. The links to those are on your screen and in the description below. Now that we know what we're looking at when it comes to an options chain, let's talk about another important factor in trading options: in the money versus out of the money. An option is out of the money if the stock's price still needs to move to the strike price before expiration. An option is in the money when it becomes exercisable, meaning that the conditions of the contract have been met or surpassed. For a call, that will mean that the stock's price would have risen to or above the strike price on or before expiration. For a put, that will mean that the stock's price would have fallen to or below the strike price on or before expiration. An in-the-money call option is one that has a strike price that is below the stock's current price because the stock's price has already risen above the strike price. An out-of-the-money call option is one where the strike price is above the stock's current price, so the stock still has to rise to or above the strike price to become exercisable. The exact opposite is true for puts. An in-the-money put has a strike price that is above the stock's current price because the stock has already fallen to and below the strike price before expiration. An out-of-the-money put has a strike price that is below the stock's current price because it still has to fall to or below the strike price to become exercisable. Hold on, before I lose you, let's bring it all together with this example of Apple, ticker symbol AAPL. At the time of this recording, Apple is priced at $148.67. Friday was a red day for Apple, falling $5.10 or 3.31% for the day. First thing we'll do is hit the trade button and then select trade options. At the top here, you'll see our expiration dates. For the sake of this example, we'll choose the October 8th expiration. Now below the expirations, you have the choice to buy or sell, and then the choice between a call or a put. Now bear in mind, we will only always be buying options. You don't want to sell an option you don't already own. That opens a can of worms that you're just not ready for. Trust me, right now, it's just not worth it. The option premiums are on the right side of the screen, inside of the rectangles. Underneath the premiums, you'll see the change. First thing you'll notice is that because Apple's price fell on Friday, the put options are all up as shown by the positive percentages in green. This shows you what I mean when I say the returns from options are amplified in comparison to the stock. Keep in mind, Apple only fell 3.31% for the day, yet the put options are up about 95%. That's a huge difference in gains. The strike prices are the dollar amounts on the left side of the screen. The share price is here in the middle. Since we're looking at puts, out of the money strike prices are below the share price, and in the money strike prices are above the share price. Now, let's say we think Apple is done falling and ready to make a move back up. We'll select call and then select our closest out of the money strike. Since we're looking at calls now, out of the money strike prices are now above the share price, and in the money strike prices are now below the share price. Notice that the further you go out of the money, the cheaper the premiums become. And the further you go in the money, the more expensive they become. This is because of the concepts of intrinsic and extrinsic value. In the interest of avoiding information overload, we will save the deep dive into intrinsic and extrinsic value for a future video if the demand is high enough. So let us know in the comment section if you would like a video covering that. For now, just know that buying an out of the money option that becomes in the money is a very profitable investment, which is why we choose the closest out of the money strike price in our options trading. One last note before we continue with the example: the break even and to break even you see listed are not important to options trading. To my knowledge, Robinhood is actually the only broker that includes that on its options chain. So back to the example. We choose the $149 call with an October 8th expiration. We see that the bid is $4.35 and the ask is $4.50. The meet me in the middle price is $4.45. Keep in mind, during the trading day, these numbers will be changing constantly. So if you want the highest chance of the order filling when you place it, it's best practice to buy in at the ask and sell at the bid. If you've chosen a stock with a tight bid-ask spread, buying at the meet me in the middle price should have a higher likelihood of filling. Which is why we believe that it is crucial to have that as a criteria when choosing which stocks to trade options for. Honestly, this is really all of the information you need to make a sound decision on this options trade. But if you want to look at the other option chain elements, click on the bid and ask, and now you have the extra details there on your screen for you. Here you can see how many bids and asks are currently in play, the volume, open interest, mark, which is the current premium price, previous close, which is what the premium was at the close of the most recent trading day, the high of the day for the premium, the low of the day for the premium, IV, or implied volatility, which in this example says Apple is likely to move 27.33% in either direction by October 8th, our expiration date. Chance of profit, which I don't believe to be a dependable metric, but it's there if you want to use it. And of course, the Greeks, which as stated in last week's video, are not necessarily necessary to understand. As I've stated many times before, the key to trading in the market is not to overcomplicate the process. There is so much you can learn, but learning too much, too fast, and trying to implement it all will more often than not hurt your trading and ultimately lose you money. Now, to wrap up our stock and options discussion, let's highlight some key differences between stocks and options. Both stocks and options are actively traded in the exchanges. With both, the risk is capped, meaning you can never lose more than you put in. Let it be known that there are ways to over-leverage yourself when trading both stocks and options and lose more than you originally invested. But we don't play that way, so we won't even mention them here. Now, options differ from stocks in that they have expiration dates, whereas stocks do not. You can practically hold shares of a company stock forever, or as long as the company stays in business. Owning shares of a company gives you ownership rights such as receiving dividend payments and voting rights. Having an option contract does not grant you any such rights. My favorite thing about options trading is that you're able to capture larger profits from smaller swings in price, as well as profit from a stock moving up or down a lot easier. Just like with everything else, I don't see one as being better or worse than the other. They both have their own benefits that I recommend taking advantage of. Here inside the vault, we invest in shares and trade options. If you're not sure of the difference between investing and trading, be sure to check out our video where we break down the difference for you. Now, if you skipped ahead to this section of the video, shame on you, but I get it. Everyone just wants to know, how do I fire this stupid job and start living a lifestyle I know I was destined to live? We talked about this concept I'm about to share last week in our $1 Million Secret to Options and Stock Trading. It's the C in CAP. It's highlighting percentage gains over dollar gains. This concept is compounding. Compounding, in theory, can turn $1,000 into $1 million in just 10 days. Don't believe me? I mean, I don't blame you, but check this out. I'm referring to the power of compounding doubles. You start with $1,000, and every day you double your portfolio. Day 1, you have $2,000. Day 2, you have $4,000. Day 3, $8,000. Day 4, $16,000. Day 5, $32,000. Day 6, $64,000. Day 7, $128,000. Day 8, $256,000. Day 9, you'll have $512,000. And finally, on day 10, you'll have a whopping $1,024,000.
Inconceivable. That's impossible.
But okay, I hear you. Maybe doubling your money every day may not be as simple a task as I'm making it seem. Unless you had some unheard of lucky streak at the casino. And I assure you, you'd be banned from that casino before day 5, if not arrested. Okay, so let's be a bit more reasonable. What if I told you that if you started with that same $1,000, and instead of doubling it every day, you just grew it by 20% every week? In a year's time, you would have grown that $1,000 into $10 million. That's even crazier than the first example, right? You probably still don't believe me, do you? Okay, let's run the numbers. You start with $1,000 and you grow by 20%, giving you $1,200 at the end of your first week. The second week, you grow that $1,200 by 20% and you get $1,440 at the end of that week. For the third week, you grow your $1,440 by 20%, giving you $1,728. We repeat this process for an entire year. At the end of the 52 weeks, you'll see that you've grown your account to $10,920,525.78.
Inconceivable.
And I know this sounds crazy. Run it through your calculator as many times as you like. You're probably saying to yourself, there's just no way that it's that easy. And you're not entirely wrong, because while the concept and the process is simple, the execution of the process is where most people struggle. For one, you have to know how to consistently get 20% growth out of the market. Luckily, if you've been watching these videos posted to the channel, you've already got a good head start on this. Then you have to be disciplined enough not to overtrade and practice proper risk management. Even after you've mastered those two, you have to have the patience to just see it through. Imagine you've managed to stay on track for a whole 6 months. At this point, you'll have grown your $1,000 into $66,247.37. At this stage, it can be very tempting to lose focus and start rewarding yourself, or even get greedy and start taking on much riskier trades in an attempt to grow your account faster. This is why every week, in every video, we stress how important having the right mindset and knowledge is to being successful in the stock market. We will continue to set the solid foundation for your understanding here on the channel, but if you want to accelerate your learning curve and earn while you learn, do yourself a favor and check out the Vault's coaching and mentoring program, where we give you the blueprint to being a market VIP. The link is in the description below. As we close out today's video, just remember, don't be afraid to fail, because it is in the darkness where we learn to appreciate the light. No battle is won without a fight. Failure should only change the strategy, never the goal. If you've enjoyed this video and want us to make more videos more often, you know what to do. Be sure to hit that thumbs up button below and subscribe to the channel if you haven't already. Also, comment below your thoughts and questions to let us know how we can continue to improve the channel. This channel and all of its content is made for you. Thank you for watching this video, and I'll see you in the next one.